Good morning, good afternoon, or good evening, depending where you are on the planet. And welcome to the beginning of another month. Here we are. August is here. Thursday, the 1st of August. Bull versus Bear webinar. Steve Miley here on the call for Trade Day. And we're really now getting into this super busy week. We get these every now and then where we get the perfect storm of central bank activity, earnings reports, and macro data. And this is the week, we get about one, maybe two a year where this all kind of coincides. And this is a super busy week. And sort of a bit unusual because it's going into August, into the summer as well. But we're obviously right in the midst of the big part of earnings season, the busiest week this week. And on top of that, we've got four of the Magnificent Seven reporting with how many of those done already? We had two last week. We've got two more this evening, and we've had one this week or two this week. Oh, we'll get to it as we go through of the Magnificent Seven. And then we've got central bank activity. Bank of Japan, as Duncan covered on the call yesterday, hiked rates, moving out of their negative interest rate policy. We've just had the Bank of England, I'll talk about that, start with their rate cutting cycle. So another central bank starting now on the rate cutting cycle with the Swiss National Bank kicking us off many months ago. And then a few months ago, we had the ECB, the European Central Bank, and we've got the Bank of England have cut rates this morning. And that was kind of on a bit of a knife edge this morning, but they cut rates. And then we've also obviously had the Fed last night strongly indicating that rate cuts are on the way, a dovish tone. And the markets, obviously, when I say the markets, I mean the stock markets, but obviously the stock markets, the equity markets have liked that. And we've seen a leap in those, and that's been reinforced by the Bank of England this morning. And then we've got all the macro data playing in as well, going into the first of the month. The first of the month, if it is a working day, and we always get the PMI data, which is always interesting to show the health of the various sectors of the economy from the perspective of the actual producers themselves. Remember, it's a survey. And then we get payroll employment tomorrow. So let's wind all that back. So a super busy week, and the market often then makes a statement through these busy weeks. We've obviously been on a significant notable correction. I've always thought this has been a correction rather than a significant downside reversal, and it looks like now we've reversed that downside reversal. So not the reversal, the correction that we've had has now been reversed back to the upside on the stock indices, and it all looks kind of bullish to me. I am certainly putting longer-term money back, or I have been putting longer-term money back to work, having lightened up and putting back to work and coming out of some cash and back into exposure on my longer-term portfolios. Anyway, because I think that's it. I think we've seen the turning point. I think it's back up to the highs and above. So let's look. What have we got in here? Let's look ahead to today before we look back, okay, and do the recap. So looking into today, we've already had some of the PMI data out of Europe this morning. You can see most of it in here. In fact, all of this PMI data. I know the manufacturing PMI out of France was slightly bit. You can see a real slight miss in here from France, 44 versus expectations of 44.1. If we look at the that's nationwide house price data from the UK, but then we've got German data, obviously the powerhouse of Europe, beating expectations. The Eurozone as a whole beating expectations. The UK data beating expectations as well in here. Then we got the Bank of England rate cut that came just shortly, recently. They cut rates from 5.25 to 5%. It was going to be a tight vote. It was 6-3. Previous was the forecast. Having previously been 7-2 not to change rates. Okay, the forecast was 6-3. It was actually even closer. It was a 5-4 split. cut to 5 wanted to cut and 4 wanted to leave unchanged. So a 5-4 split, but that means they cut rates. So they cut rates in here, and we've got the minutes. We had the minutes. We've got the Bank of Inflation letter. We get Bank of England inflation letter coming up, and also Bank of England Bailey speaks. Well, he's speaking now actually. So he is speaking now. Looking ahead into today, though, we do get this initial jobless claims. It doesn't usually have a big impact on market. More significantly, we get the US PMI data. So first of all, from S&P Global. Now, this isn't as important as when we get it from the ISM. So 9:45 Eastern from S&P Global. 10 o'clock we get from the ISM, the Institute of Supply Management, Manufacturing Employment Manufacturing PMI data. The PMI data, that more important print, but also the prices paid data as well. So we're watching out for that at 10 o'clock today. So those are all going to be important. We're looking into those as we go into today. Just while we're here, a quick headline on that. So there's the Bank of England, cuts rates from a 16-year high. From 5.25% down to 5%. So there you go. And there, it was very split on the market as well. So economists polled 60% chance of a rate cut. The market was almost pricing in 50-50 whether we would get a rate cut today. So that rate cut obviously reinforces the view of global rate cuts, easing rates, inflation being under control, and should also then obviously be beneficial to stock indices, both in the UK and globally. On the earnings side, looking back before we look forward, Meta yesterday helped the fact that, so the Fed, we'll come to the Fed shortly, okay, but the Fed obviously gave a fairly dovish tone. We'll talk a little bit more about that as we go forward, which sent stocks higher. After hours, we had Meta. And Meta beating expectations of both revenue and EPS, earnings per share. You can see in here, both in green from yesterday. So that was certainly a notable positive in here. And that helped markets even higher after the bell last night. And going into today, all eyes on two more of the Magnificent Seven. So I don't think, who did we have early this week? It was 4 of them. Oh, I know. We had Microsoft, right? So Microsoft was a bit of a disappointment. So last week, Google / Alphabet and Tesla. Early this week, we had Microsoft, and then yesterday, Meta. So that's helped markets higher. Got a couple of the big boys in here today. Apple and Amazon. Okay, 3.4 and 1.95 trillion dollar companies in here. They're upcoming after the bell, though. Remember, after the bell, after the cash market closes this evening. Also after the bell, we get Intel. So sometimes it gets overlooked because this often comes out with some of the other big guys. But Intel's important as well to reflect the state of that whole chip sector. So we'll certainly be watching Intel as well going into tonight. Let's run through all of this that's going on just from the newswires perspective. But I've covered a lot of it in here anyway. But so the Federal Reserve kept the interest rate on hold, but that was expected. But signal cuts are getting closer unless progress stalls on getting inflation back to target. Jerome Powell said policymakers will keep watching that closely, but if everything is moving in the direction it is now, then a reduction in our policy rate could be on the table as soon as the next meeting in September. So the clearest sign we could have. Markets obviously went higher. When I say markets, I mean stock markets, but also treasury markets went up in price, lower in yield. In here, US stock futures on the overnights with that metadata as well pushing forward. Facebook and Instagram parent Meta, there's the stuff about Meta, is rising with pre-market trading of it, resulting in AI investments are paying off. This has been the critical thing. Duncan touched on this yesterday. I hope you got on well with Duncan. Bear with him on the technology side. He's still getting used to that side. He's not used to using our systems, but he's got a lot of insights. He's going to bring a lot of value to the webinars as well. So I hope you enjoyed the webinar with Duncan tomorrow. And once he gets his handle on the technology side of things, I'm sure things will be a lot smoother as well. So, but Duncan mentioned this yesterday that the critical thing in here. Yes, AI is going to be a boost. Yes, we've had a massive run up with expectations around AI, but when's it going to start paying off? When's it going to start kicking in? When is it going to deliver profits? When is it going to be? Because there's obviously a lot of investment going into it. Yeah, that benefits Nvidia, but when are these other companies, these other large tech companies, going to benefit from it? And Meta indicating that AI investments are paying off by driving sales of more targeted advertising. There you go. So there's an immediate benefit to the company, and then obviously and that's then boosted other tech stocks as well. And Nvidia led the way up 329 billion added in market value yesterday. Big jump on Nvidia. The $1 trillion club, Apple and Amazon after the close. We've already mentioned that. Beyond Nvidia, the picture of the chip is less rosy. Qualcomm rallied after its results, but fizzled amid worries of a slowing recovery. And ARM Holdings slid after it's stuck to a tepid forecast. So there's also some negatives out there over the last 24 hours. Oil prices are up. Middle East tensions keeping more oil prices elevated in here at the moment. That can be a negative for markets in here because obviously higher oil prices, like a tax, like it's a tax on the global economy, right? It's very narrow in who it benefits. So higher oil prices can lead into inflation, can lead in a slowdown in growth. So higher oil prices can be seen as a negative, but at the moment, not really significantly impacting into the markets. They're looking at the Fed, they're looking at the results from these mega cap stocks. So just to run through a load of headlines in here that we've got, basically just recapping everything I've said. Fed on course for September rate cut as risk to jobs markets grow. So they're seeing risk to the job market. So clearly Friday's jobs data is going to be important. If they start to see, obviously, inflation under control and the job market start to loosen, so a tight job market is one where the labour force is in control. If we see a loosening of the jobs market, there's fewer jobs. And then we could see the Fed start to act a little bit more quickly and maybe more aggressively. So citing risk of further labour market weakening from the Fed yesterday. US stocks poised to extend rally after the Meta beat as well. Bank of England delivers first rate cut in narrow vote. Oil gains on a second day. We've covered all of that already. And we've covered all of this I'm going to run for you now. Futures up as rate cuts hopes prevail. Meta climbs higher. Also from Reuters, S&P 500 and NASDAQ boosted by chip rally, Fed rate cut signals. Yep, we know this is what I've already run through already, but just running through the headlines. Meta's upbeat earnings, buy time for AI investment to pay off. So again, pointing the fact that they are getting the results coming through. Nvidia adds a record $329 billion. Big leap in Nvidia yesterday. So a 13% rally after 7% lower the previous day for Nvidia. Oil extends surge and report Iran orders retaliatory. This is why oil is up. And Fed nods to cut, chips rebound, Bank of England up next. Well, this is an older headline, obviously, because the Bank of England are already gone. Let's see how that's impacted markets around the world in here. So actually, Nikkei was down 2.5% in here on the overnights, and the Hang Seng down 0.25%. But the Asian market's very much detached on a day-to-day basis at the moment from the US and European markets. The UK FTSE is only up slightly in here, only up just over a tenth. And actually, the European exchanges are actually lower in here this morning, with the DAX and the CAC down 0.75 and 0.85% respectively. But obviously, we had that big leap yesterday, and stocks in there pointing higher again this morning on the futures. 0.6 up on the NASDAQ and nearly 0.5% up expected on the S&P. Let's dissect this CME FedWatch tool now. So if we look in September now, not only nailed on for the first rate cut, but now this is actually grown. This is for 50%, a potential for, keep saying 50%, 0.5%, 50 basis points, a 50 basis point hike. So this is for 25, not hike, cut, God. 25 basis point cut, 88.5%. But there's an outside chance, 11.5%. The market's starting to price in a 50 basis point cut. There we go, got it right. And then into November, what's the chance of us only being down 25 basis points in November? Only a 26% chance. So the market's pricing in potentially, so this is like a 74% chance here between the two bars, the middle bar and the bar on the left. And it's 74% chance that we get 2 rate cuts, or that we have actually a total of 75. There's a 9% chance that we're 75 basis points down. So there's a 50 and a 25. Maybe they start big, a 50, and then they go 25. That's what the market's pricing in, an outside chance of that. I mean, the likelihood, though, basically now, September, November, December cuts. So 25 in September, 25 in November, and then just before Christmas, 18th of December. So remember, the current rate is 525 to 550. That's where we are right now. And so the market now pricing in that we're at 450 to 475. Okay, so there's only a 25% chance in here that we only have a 50. We're down 50 basis points, so effectively 2 rate cuts. Okay, and then there's a 75% chance that we get 3 rate cuts, and an outside chance in here. Look, so this is 425 to 450 that we get a total of 100 basis points down. So basically, adding up here, these two, 11% chance that we actually get, we're down 50 20, that we get 50 25 and 25, but really the market pricing in 3 rate cuts now going into the end of the year. Let's take a look at what that's done to yields in here, and you can see a significant break lower below these previous low yields from the middle of July. We surged higher in price, down in yield, smashing through that yield low there, and significantly gone down and basically halted at this yield low. This is from August 2024. Okay, so this is from nearly a year ago. Okay, it's actually the 3rd of August, almost a year to the day, right? So that low yield there is at 404. If we break there, we'll be at the lowest 10-year yields for over a year in here. Okay, so it's an important level. If we get down through there and down through 4%, that'll be a significant milestone for the market. And that, lower yields, higher prices is significant for the equity markets as well. There's a positive correlation. Here you can see the US 10-year yield. I'm thinking this is the level up here. 112.25 is going to be critical on the top side for the 10-year note. Still some ways away from that, but we can get up towards that. We've already broken up through significant levels in here anyway, but 10-year notes certainly pointing higher in here on price as well. And then the indices, we've flipped to more bullish. I was feeling like we were going this way anyway, but on the S&P you've got a little double bottom put in. We've been speaking about that basing pattern on the charts we're looking at, and then also the basing pattern and the trying to recapture the old trend line in here. And if I quickly jump in here, hopefully I've got the right screen up. Yeah, here we go. If we go in here and we go to the 30-minute charts, this is what we've been talking about for a while in here. This kind of double bottom pattern sort of forming, and then the pattern formed, and now we're basically, it's over here, got this double bottom. You could argue it's almost like a triple bottom in here now. 1, 2, or actually a quadruple bottom. 2 here and 2 here, and then you've got these multiple peaks, and the market obviously took that out, and then it's off to the races. Now the whole measure of this, and I think we could hit this today. We were already broken out yesterday, right? But you look at the measure. So this is on you would look at this whole base for the double bottom as the measure for the target. We could hit this target today. So the base approximately, we did this more recently, and we kind of nailed it when it broke further to the downside. 55.34 to 54.32. Well, that's basically 100 index points, right? So then the target would be 100 index points up from 55.33, so 56.33. So 56.33 is a potential target for today, and I wouldn't be surprised if we get up there. What's this little swing up here? That's not far off as well, this swing high up here. 56, what's the high there? 29.75. So 56.33 is definitely a potential target for today for the ES. It's doing the similar on the NASDAQ in here. Again, you've got this we did lurch lower on the NASDAQ, so you kind of not quite a double bottom, but it didn't spend too much time down below this previous low in here, so spiked down there. And then you do the same measure in here. So for the NASDAQ, you'd argue it's somewhere between, well, let's say it's 19,400 approximately, 18,890. I'm going to say 18,900 just to make the maths really easy. Okay, you could argue it's all the way down here, but I'm going to say it's 18,900 up to 19,400. So that's 500 points. Okay, on the NASDAQ, up from 19,400. So 19,900. That's an easily attainable target for the NASDAQ today, right? Up towards here. So we could easily be there. 19,900 potential target, maybe even visiting as high as 20,000. I don't think you'll see 20,000 before the closing bell, but you might see it after if Apple and Amazon come in the right way. So 19,900 initial target, maybe as high as 2,000 today, I think, for NASDAQ. I wouldn't be surprised if we go off to the races because we're getting green lights. The market was kind of trepidant, but we've now got 4, or is it 5? the four of the Magnificent Seven behind us, they've actually been disappointing. Three of the four Magnificent Seven that have disappointed, and the market has still gone higher, right? Still managed now to rebound. We've had one go well, and it rebounded, obviously helped by the Fed as well. If the two this evening are pointing in the right direction, we could be off to the races. And then bigger picture, I wouldn't be surprised for the ES and the NASDAQ in the next few weeks and as we go into mid-August to be back up to the highs. I wouldn't be surprised. We don't usually get much price action through the summer, but I wouldn't be surprised if we go back up, get another boost in here over the next few days, and then through the summer into the first 2 weeks of August, we head up back up to the highs, the all-time highs up here on the NASDAQ and up here on the S&P. I mean, that will be my view for the next couple of weeks. I think we're setting up now for a summer rally. All right, guys, I'm going to leave it there. I'm going to wish you all a great trading day. Take care, stay safe. I'm going to leave you in Duncan's capable hands tomorrow. He'll be back with you tomorrow doing a look at what we've had from Amazon and Apple this evening. He'll take a look at that. He'll also take a look at a little run into the employment report and to see what that's going to do. Remember with the employment report, I let him talk about this, but it's could be counterintuitive. A weak number in employment we'll probably see stocks higher, right? A weak number seeing stocks higher because there'll be more an anticipation of a more dovish Fed. The Fed could actually go bigger. If we get a really weak number, the Fed could go bigger. They could start with a 50 basis point cut, right? So if the Fed, a weak number on the employment could actually be positive for stocks. It's kind of counterintuitive. And equally a strong number, if the number's too strong, it might put the Fed off from being aggressive. It might mean the Fed only go less than the market's expecting, and we could actually see stocks lower. I think if it's around in line, stocks will like it. That's my view. But I'll let Duncan talk a bit about that, and he can give you his view. Different views, that's fine, because that's what makes up a market. All right, guys, I'm going to leave it there. Do remember as well, Duncan wasn't quite aware of some of our rules. Okay, so obviously last night you couldn't trade over the Fed last night. Remember tomorrow, guys, because I'm not going to be on, and you can't trade 2 minutes before or after the employment report. No trading, no open positions, and no working orders in the order book 2 minutes before the employment report and 2 minutes after the employment report. Outside of that, do what you want within the rules. All right, guys, I'm going to leave you. I'm going to wish you a great trading day. I'm going to wish you a great weekend too, because I won't be with you tomorrow. Duncan will be with you, and I'll be back with you at some point next week. Take care, guys. Bye.